The first reaction felt almost like an exhale. Inflation data came in softer, and for a brief moment, the market allowed itself to believe that pressure from policy might ease. But the relief was restrained. Investors weren't rushing back into risk, they were simply stepping away from the edge. The tone felt cautious, as if participants understood that one encouraging signal doesn't resolve a longer uncertainty. Money stayed selective, choosing patience over enthusiasm, watching to see whether stability could actually hold. What mattered more than price moves was how selling spread. It didn't remain contained. Once uncertainty entered software, it began to seep into areas that normally move for entirely different reasons. That kind of transmission tells a story about positioning, not fundamentals. Investors were reducing exposure where future visibility felt fragile, suggesting that confidence in long-term earnings narratives had quietly weakened. The market wasn't rejecting growth, it was questioning how durable that growth might be. Artificial intelligence remained the underlying tension, not because investors doubt its potential, but because its impact is uneven and unpredictable. When disruption accelerates, markets struggle to price winners and losers at the same time. That uncertainty forces capital into a defensive posture. Instead of chasing opportunity, investors begin protecting against misjudgment. The pressure seen across multiple industries reflected that transition from excitement to evaluation. Policy signals added another layer of hesitation. The message from the Federal Reserve was measured, almost deliberately slow. Officials acknowledged progress but resisted declaring victory. That tone matters. When policymakers avoid urgency, markets lose a clear timeline to anchor expectations. Investors are left navigating probabilities rather than direction, which naturally reduces conviction and encourages shorter positioning horizons. Market participants interpreted the same information differently. Some saw confirmation that inflation pressures were easing, while others focused on how resilient economic activity remained. This divergence prevented consensus positioning. Instead of a unified move, capital fragmented, with investors expressing views through selective exposure rather than broad risk-taking. The market felt balanced, but not comfortable, stable on the surface, uncertain underneath. In the end, the market didn't choose a direction. It paused. Positioning suggested neither fear nor confidence, but reassessment. Investors appeared willing to wait, allowing more information to emerge before committing capital decisively. Moments like this rarely feel dramatic in real time. They feel quiet, indecisive, and slightly uncomfortable, the kind of environment where narratives are rewritten before prices fully reflect the change.